that you're going nowhere. Don't blame me for what you've done, because I know that you were having fun.
Welcome to the Clarified Realty Podcast, exposing the real estate secrets your agent doesn't want you to know. Here's your host, Tom Clary.
Don't you just walk away. That's when I'll say.
Welcome to the Clarified Realty Podcast. I'm Tom Clary, and I'm your host. I'm a real estate agent here in the beautiful state of California, Los Angeles to be exact. I'm here with my co-host and buddy, Ron Bruno. How you doing today, sir?
I'm doing great, Tom.
Good. So we're going to do a special episode today. We had kind of a great response to an episode we did prior to this a couple of weeks ago about basically how to get the edge in this market. Right now, we're dealing with a market that is completely seller leaning. There's not a lot of inventory out there, and people are having, especially first-time home buyers, getting an edge in the marketplace. I mentioned on that podcast where we had an agent that I know. He had the picture on his Instagram account where he literally had on his desk 20 offers for one house, and so. How can you get yourself to kind of separate yourself out from all those other people and get an edge in terms of getting your offer accepted? And we've come up with 10 definite action items that can possibly, if you implement them, basically get you an edge in the market. And so I'm going to basically be going through these one at a time, and we'll just go at a little bit more detail into it and discuss each one. So the first one, our tip number one, is look for homes below your qualification/budget range. So Ron, why don't you go ahead and talk a little bit about that?
Sure. So, and first of all, right now, and this applies to Southern California.
Yeah.
Right. So that's the disclaimer. We're looking at markets where there is an overwhelming there's leverage on one side of the transaction,
and that's with the sellers.
And that's with the sellers right now, right? So
they're in the driver's seat.
That's right. So if you're trying to submit an offer, it's like, I saw one post. You mentioned Instagram. I saw one agent where in the first 15 minutes they had 60 potential buyers through the open house. They had cars up and down both sides of the they had it all along the driveway and then both sides of the road. And I mean, I was thinking it was like Black Friday.
Yeah, were they giving away Blu-ray players
to
the first 20 people through the door? Or
exactly.
What was it?
But here's the thing. Only one person can buy it.
Yeah.
Right? So imagine Black Friday with all these people lined up and only one person can buy.
Right.
That's what's happening in this market, right? So knowing that and knowing your, what you're up against and the huge headwinds, here's some ready things. So the first is, these are for first-time home buyers, right? So the first 6 tips. So the first 6 tips. So number 1, look for homes below your qualification budget range. Okay, so if you're pre-approved for $500,000 and that's your max, and that homes are selling for $40,000, $25,000, $100,000 over asking, then don't look at homes at $500,000.
Right.
Right?
Yeah. If you're getting yourself into a situation where there's a high likelihood that you're going to be going up against 10 other people, 12 other people, whatever, there's probably going to be a bidding war. There's probably going to be a back and forth that's going to happen. So what you have to do is you're controlling that situation by actually knowing that you're looking at a property that's lower than, and you have that room to go. You have a room to go up if you need to.
Yeah, I mean, I was looking with someone, right? They were maxed out at $759, and that was what the list price was. And I was working with a newer agent, and it was for a duplex, or actually it was a threeplex, and that was it, right? So we submitted our offer and couldn't jump up there. That home, that triplex, sold for $1.1 million.
Wow.
Listed for $758.
Yeah.
That's insanity.
That's crazy.
Right? So why would you start at the top in terms of, your qualification range and start submitting offers? Because you're going to get bid up in this particular market. So that's tip number 1.
Now,
I will say, save your sanity.
I will say that with this, another key part of this story is that your agent should also, any agent that is worth their salt is going to know how much further up that property can go. So
Correct.
you need to know what your ceiling is. I spoke about it on my previous podcast that people have this hesitancy to, I don't want to get into a bidding war. Well, it's not about the bidding war. That's, knowing what your top is, that's really, and how far that neighborhood will handle going up. So if you have a home that is listed at $400,000 and your agent says, well, you know what though, in this market, it could probably be appraised at more around $425, or there's a range, then you know that, okay, my top is going to be $425. It doesn't matter what somebody else is doing. You're basically, what your top is. It's not like something, overcomes you and you go, oh my God, keep on throwing money at these people. No, you say, that's my top. I know that neighborhood can only take it up that high. I'm not going to be, cajoled into going any higher than that. So the second tip, ask for help from family, parents, grandparents. Go into that?
Yeah, aunts, uncles, siblings, all of these people can gift you money.
Yeah.
Right? So if you find a home and let's say you're, with the down payment that you have, 10% or 20%, and the most you can afford is $400, but you really need to get to a $450 range.
Yeah.
This is the time to ask for help.
Yeah.
Right? Because of the gifting laws, family members can gift you money towards the purchase of a single family residence, of your home, of a primary residence where you are going to live, right? You can't get gifts for investment properties, but you can for primary residences.
Yeah.
So this is the time to ask for help. And a lot of family members, this is what they're designed to do, right? Parents, they want to help out their kids, and family members, they want to help out help people out. So it can give you a little bit greater purchasing power by asking for those particular gifts. It can also save you money, right? So when it comes to the actual mortgage payment, the more you put down, the less your mortgage payment's going to be.
Right. And by the way, we're not in any way advocating overextending yourself in any way in order to by getting more money into the deal, by bringing it in by your parents and all that kind of thing. We're just saying that in terms of possibly getting more opportunities open for you, it might behoove you to start, calling in favors.
That's basically. Right. And, in one case, when it comes to a non-occupant co-borrower, they don't actually have to live with you and they don't actually have to be a family member, right? So you could get someone as a close friend, a close relative, and they can come on the loan with you. And what we do is we will actually look at the strength of both of you. So you want to make sure that if they're going to come on as a non-owner occupied co-borrower, you want to make sure that they have good credit.
Yeah.
They are not overextended because we're counting their liabilities as well.
Yeah.
And they make good income.
Yeah.
Right. Those are the right people. So you want to call out the rich uncle.
And we're really talking about opening up opportunities for you. We're not necessarily saying that that's going to, if there's 10 deals on the seller's desk, that's going to somehow make you stand out. What we're saying is we're trying to open up options for you, that you're not just in this one tract of houses that, if you can't, there's only, 2 houses a year that go for sale, your options are incredibly limited. But if you can open up by getting more resources, you get more options. So that's really what we're talking about here.
Exactly. Yeah. So you can employ those types of strategies to give you a leg up on the purchasing power. Just know that if you have that rich uncle, your loan is going to be on their credit report.
Right.
So make sure you pay your bills.
Absolutely.
It'll be very awkward at Christmas.
So let's talk about tip number 3, which is equity sharing problems. Now, this is a relatively new thing that's kind of come up. Once again, it's another opportunity to give you more resources and give you more possibly skin in the game. Why don't you talk a little bit about what an equity sharing program is and how they work, and then how that can potentially help someone possibly get more options.
Right, exactly. So, one of our programs that we have available is through an investor. So it's not a loan. It is actually...
And by you mean...
Guaranteed Rate,
which is the company that Ron works with.
That's right. So Guaranteed Rate has a program through Unison. And Unison, it's based out of San Francisco. And what they do is they actually will match your down payment, right? So let's say it's $500,000 as a home price, and you have 10% to put down. If you have 10% to put down, that means that you're going to be paying mortgage insurance, or you're going to be paying, taking out a second loan. If you don't want to have mortgage insurance, you could have a HELOC, right? So these things increase your purchase, it increases your amount that you're going to be paying. It also decreases your purchasing power, right? Because we have to factor in the cost of the mortgage insurance, as well as the cost of the HELOC, if that's what you're doing, the home equity line of credit. And that factors into your debt to income ratio. So what Unison has created is, here's a way that they will match that 10%. So you start with $500,000 purchase price, you put down 10%, and then Unison will match that 10%. Right? It doesn't qualify for everyone, and it's not in every location, but in most metropolitan areas in Southern California and Northern California, this is a great program, because what it allows you to do, let's say you take that 10% that Unison matches, so $50,000. Now they're contributing to the transaction. What they will do is they're going to take an upside stake in the appreciation of that home. Right? So let's say the home in 10 years appreciates to $600,000. Okay. And let's say your mortgage is down to, you started at 450, maybe it's down to like, 350, 10 years from now. So now what they're doing is they're just taking a stake in the upside appreciation, 35% on average. So what they'll do is they will take the original 50 and let's say you sell the home, right? So they're only taking the actual proceeds once you sell the home, right? So they will take their original 50 that they invested, right? So you have to give that to them, plus another 35% or $35,000 if it appreciated $100,000, and they take that. But you've saved so much in not paying that mortgage insurance, and it gave you greater purchasing power, right? So maybe you were only approved where you could buy a home for $450, but now you were able to buy it for $500, right? So it's just another tip. It's just another option to get into a better situation.
Right. I mean, more options.
And it's not for everybody, right? So if you're anti-equity sharing or anything like that, and also you can, you can buy them out after 3 years. Right. So you don't have to wait till your home appreciates to $100,000 and you have to sell, or want to sell. After 3 years, if it goes up 25%, they'll take 35%, 25%.
But it's good to know options. It's good to know options that you can, look, I can actually do this if I want to do that. Some people are going to go, no, that's crazy. I wouldn't even think about doing that. That's cool.
Yeah.
That's good for you.
Yeah.
But some people might go, oh my God, that's perfect. That's exactly what I'm looking for, and jump right on it. And then pay it off in 3 years or whatever, because they took advantage of the opportunity.
Exactly.
So anyway, so tip number 4, adjustable rate mortgages. So basically utilizing their possible lower interest rate right now in order to give you more purchase power, correct?
That's right. So these are called ARMs, or adjustable rate mortgages, and a 30-year fixed loan is a longer term. So the rates are going to be, let's say, mid-4s. And for an ARM, it's fixed for a certain period. So, just very quickly, a 7/1 ARM is fixed for 7 years. And then after starting in year 8, it will actually fluctuate based on the prevailing rates in the market, right? And ARMs, they have caps on them. And we talked about that in previous episodes. But let's say the 7/1 ARM is at 3.625. Right? I'm not saying that's what today's rate is. I'm just saying, let's say it's there. Well, now, if I'm looking at an ARM at 3.625, the monthly payments are going to be much less than if it was at 4.5, right? So again, it increases your purchasing power. Now, keep this in mind. When it comes to ARMs, you want to have a good idea of your time horizon, your income fluctuation, and your pulse and your, just your overall gut on risk.
Yeah.
Right? Because if you are an engineer and you like stability and you just get a steady paycheck and that's what you want, then you probably don't want to do an ARM.
Yeah.
Right? But if you are a young starlet, that Brian manages, and you just got your latest film and you're on your way to Kate Beckinsale's, star status, and you're going to buy the home you're buying is a condo, and it's just you're going to be trading up in a couple of years, ARM might work.
Yeah, and by the way, I always, when it comes to ARMs, there are some people who are philosophically against them, and that's cool.
Right. That's just like an equity sharing program. That's not for everybody.
Absolutely awesome. But once again, this whole thing is about options, and it's about doing. If you have the what's the word I'm looking for, the constitution for it, the stomach for it, then this might be the perfect example of something you can jump on in order to help you get more options. But once again, use them carefully. do not use them without having some, I would say a good working knowledge of them and knowing what each specific, rule of your arm is. If you decide to go there, make sure you know that, in 5 years it can adjust to X or whatever.
Correct. You want to know the actual
You want to know it
terms.
backwards and forwards.
You want to make sure you know the terms, and that applies to HELOCs like we talked about, right?
Yeah.
So with arms, you want to know about the caps. You want to know, what your actual max rate could be.
What's your impact? What's your possible liability?
That's right. And if you're not comfortable with it, then don't do it.
Don't do it.
Just do 30-year fix, 15-year fix, whatever your comfort zone is.
Great. Now, tip number 5 is look into fixer-uppers. So basically looking into homes that are a little bit long in tooth. Maybe they've got some ugly carpet. Maybe they got some not so fantastic wallpaper on the walls. But there are a lot of finicky people out there. And there are people who will walk into a house and they will literally look at the 4 walls and go, ugh. And they'll turn around, and that's when you win. That's
right.
when you win, because you can see through that. You know that that's just surface. If there's some sort of problem with the structure, well, by all means, please don't go there. But if it's something that a coat of paint is going to take care of, you have to walk into homes with better eyes nowadays. You have to lower your expectations if you really want to take a shot. You have more opportunities in front of you. That's all we're saying. Right?
Yeah, so you have to have a stomach for being a DIY, a fixer-upper, and there's a little romance about it too, right? So it's all about putting your own finishing touches to the particular property.
Your own.
Make it your own, and your options that are available. You certainly can, come in maybe a little bit below your budget, and then you use some of that extra down payment to the renovations itself. But let's say, you find the lowest price home in the best market, and you're still really there in terms of you're right there at your max. Well, what you could do is you could look into renovation loans. Right? So what renovation loans allow you to do is allows you to actually finance the cost of the renovation and your loan amount into one low monthly payment, right? Into one loan. And you're able to close in the 30-day escrow, and you're able to do all of the renovations within a six-month time period. So you're able to, let's say the renovations cost $45,000 and it's going to take 3 months to do. We can do up to 5 installments paying the contractor, and then they pay their people, and now you have the home that you want. Another piece to this is, let's say you find a really big fixer-upper.
Yeah.
Like there's a hole in the roof, or it doesn't have heating, or certain things that don't conform to FHA or Fannie Mae or Freddie Mac standards. Well, now you got a big issue, right? Because now you can't close in 30 days. But if you do a renovation loan, what you could do is, as long as you factor all those things in, and the renovation includes fixing this up to bring it up to code, then you can close on it, right?
Are there any kind of issues in terms of first-time home buyers or new buyers basically getting into these deals? I mean, is there anything that's like FHA has an issue with? Like, I'm not, you know what I'm saying?
Mm-hmm. Yeah. So there's a couple of things. So, with each of the various lenders, FHA, apparently they're big on termites, right? So if there's wood rot, like they want to see the inspection report, right? And lenders, we typically don't look at the inspection report unless there's something that's called out on the appraisal, right? Or something they see, right? Because the underwriters, they're not looking at this on their iPad. They're not looking at it on their phone. They're printing it out, and they're taking a fine-tooth comb looking at all the pictures of those appraisals.
Yeah.
So, and their job is to spot certain things, right? So if things are popping up on the appraisal, or the appraiser says there is visible, wood rot damage, then the underwriter will ask for a copy of the report. So, FHA has, it seems to have higher standards when it comes to the property, which makes sense, right? Because they're taking on a lot of risk because, it's lower down payments, usually lower credit scores. So they scrutinize the property a little bit more.
Sure.
Right. VA, they tend to also scrutinize the property, right? And so these are things that you definitely want to keep an eye out for. I've actually seen these renovation loans save deals, right? So let's say you have the buyer and the seller, and the buyer really wants the home. The seller doesn't budge. they're not going to do the repairs, and now you're stuck where, the lender's not going to close on the loan because the repairs aren't going to be done within the given time frame. Well, now you can do a renovation loan. They come, the renovation team comes in and you scope it out, where you actually have the contractor gives the bid as part of that fixing, uppering, whatever it is. That's all part of it, and now it qualifies. Now you can actually close as long as that work is to be completed. So the answer to your question is yes. So
but there are ways around it.
There are ways around it. Yeah. So you want to be crafty. You want to think of things outside of the box, and that all starts with the right team. So
yeah, and by the way, that's probably why you're here in the first place. Folks who listen to these podcasts and folks who follow us, I'm always assuming that they're the ones who are not just taking things at face value, that they're actually trying to find out how the actual mechanism works so that they can do what they can to assist and grease the wheels.
Exactly. And renovation loans are very specific, and they follow a certain formula and criteria. And at least with guaranteed rate, we offer them. I don't personally do them. Yeah. Right? We have a team that does them. So I actually do that as a handoff because they're experts at it, and they're the ones that educate the consumers. And, I know enough to be dangerous. I know enough to entice people to consider it as an option, but I'm not actually doing the loan.
Got it.
Right. So I'm certainly apprised of what's going on. But it's specialty. So, you reserve those, similar to like a reverse mortgage.
Got it.
Right.
So next is number 6, which is use of delayed financing.
Yeah. So what do you think?
Go into that.
Yeah. So delayed financing. So sounds kind of interesting. So let's say you have a property and it's all the bids that are coming in are all cash. And it's just super red hot, and you have tons of investors that you're competing against, and everyone's offering 10 days, no contingencies, all cash.
Excuse me.
And you're getting beaten and bloodied. If you have the means, only if you have the means. The only way that also work is if you have the means, where you have the money, and you can buy that, but you don't necessarily want to tie up your entire nest egg, your entire net worth into your home. You have this option called a delayed financing, where we actually treat the terms very similar to a purchase, right? Because, typically if you buy a home and then a year from now you do a cash out refinance, well, it's going to be a little bit bigger hit in terms of the rate versus if you bought that home as a purchase, right? Because it's a little bit, there's a little more risk involved in the transaction. But delayed financing, as long as you buy that home and you do the financing within 6 months, you could actually do the cash out and take your money back, and you can close on that home, buy it cash, and then we do the delayed finance where we just set it up where, similar to a refi, we still do an appraisal. You show that you did not have a loan involved in the transaction, and you get your loan, right? And you make your regular monthly payments, and it just gives you that leg up if you have the means.
Well, and that's and I think you really need to kind of let's take us back a bit in order to go into more detail about how that gives you the leg up. And it's fascinating because what you're really talking about is when you have 10 deals that the seller's choosing between, and they have to sleep at night knowing that they backed the right horse, they chose the right one to go with. It is always, well, almost always, I shouldn't say always,
right,
but it's almost always the cash one that they choose, because the cash is cash. They don't.
Right.
It doesn't have to be underwritten. It doesn't. There's no kind of 11th hour problem that is going to
There's no appraisal.
No appraisal. But although there is appraisal with this though, but you can go into that a little bit more too. But basically, what you're doing is you're converting it into a cash deal, even though you're eventually going to get financing for it. That
Correct.
could put you ahead as part of the deal. So go ahead and...
Yeah, and you could also... So I had this happen, right? So I had a friend of mine where he was competing and he wanted to buy a condo, and, he was able to obtain, this money up front, but because of the terms of the money, he needed to make sure that he really was going to get financing, right? So it's not like... he could just hold on to that money forever. No, he has to replace it. So, what we did is we went through and pre-underwritten right? So we did a pre-underwrite where we actually, took it where we underwrote his credit, his income, his assets, and the underwriter said, okay, here are your conditions, right? So we know that when he buys that particular home, that we're good, from a credit and income, basically on his side. Now we still have to do a condo approval, right? And we still have to do an appraisal. So all these things, there are some unknowns, right? You can't, it can't be 100%. And, so you have to be prepared for those things, but you can start to chip away at some of those unknowns. Right. So those are things to keep in mind when it comes to delayed financing. But if it's an option and you have the cash and the ability to go ahead and close, then you certainly beat out people that are doing 30-year fixed, or 30-day escrows and loans attached to it.
Right. Which is a big, fat question mark.
Right.
In that seller's mind. The more that you can remove question marks from a seller's mind, the better chance you have. It's interesting because one of the big questions that I always get all the time from my buyer clients is that, well, it's just about how much money that we're going to put up on the deal. I was like, no.
Right.
It's actually not. There are some times where if it's all cash, they might take less money because they know that it's going to close.
Exactly.
So anything that you can do to remove the question marks from the seller's head, it's going to put you above all those other ones.
That's right. And it also depends on, the motivation of that seller. Someone who just wants money, then they might just take the cash deal, right? Because they just want certainty. Whereas, there are some sellers where it's more sentimental and they want it to go to a nice family and they want to make sure that they don't tear down the home and convert it to dirt. And start from scratch.
I want to make sure that this is another one I kind of want to interject as a side tip here, not part of these 10, but something that's incredibly important, that your agent, and so amazingly important that you're picking an agent that really knows how to go to the other side and find out their real needs. Sometimes it's not about the price. Sometimes that's a huge part of it, of course. That's most of the time, that's a huge part of it. But you'll go to them and you'll say, well, what are they really looking for? Like, what is it that's going to really touch them or going to, give them, use some leverage? It's like, well, look, they're still looking for another house. Maybe I can give them leverage by helping them out and doing a free rent back or something that somehow solves a problem for them. So you need an agent that is being proactive about calling the other side, not just submitting on a piece of paper at 5 o'clock the day before the deadline. Somebody who's on the phone with the listing agent saying, okay, what do they really want? That's huge. That's a huge deal.
Yeah.
And it also sets up rapport as well.
Absolutely. If you can get backstory, if you find out that it's just it's an estate sale and it's 4 brothers that are just trying to get the money quickly. Okay. So you know what your strategy
bottom line is
going
the
to be
bottom line.
But if you find out that, it's an elderly couple and, they
lived in the house for
50 years and, all their kids grew up on the neighborhood and that they're looking for just, solid people and to be, they feel an ownership and a responsibility to the community, to the neighborhood. These are things to keep in mind.
Yeah. Okay, next, tip number 7. So talk about leasebacks and how that can help. Basically, we're now moving into the existing homeowners.
Right.
So before, what we were talking about for these first 6 tips was the first-time home buyers, the people who don't have any kind of other home that they have to sell first before they go and buy their first home.
Exactly.
So now we're kind of moving into we're going to try and help out the folks who are out there who already own a home and how they can possibly get an edge. So let's talk about leasebacks and what you can do in terms of helping yourself out that way.
So if you own a home and you're trying to buy a new home, you've got a little bit of a dilemma.
Yeah.
Right? There's on the surface, there's the whole moving thing in, moving out of one place and moving into another, especially if you own it. There's the other piece of it, and that is, your option could be, you could certainly, when you're trying to, and I would say the most traditional one is you do a contingency sale. Right. So that's a very standard type thing. Where,
and to explain that, you're basically what you're doing is you're saying that we want to buy that home, but it's contingent on the fact, or contingent on the, I don't want to say possibility because you don't want to say that,
right?
But it's contingent on you selling your home that you're in already.
That's correct. Yeah. So what you would do in a traditional sense is you would primarily submit an offer for 60 days. And what you say is, okay, so it's contingent upon selling my house, listing it and going through escrow and closing. And then once the home is in escrow, the home that you're selling, then now you are able to move further down the pipeline. And what happens is you're in the process of buying the new home, and it's almost, we call it a simultaneous close, right? So you close on the home that your home that you're living in now. So the one you're selling, and once those proceeds flow to escrow, then escrow will record it, and now you're able to then move the money over to the new buyers, right? But in this market, if everyone's submitting 30-day escrows or all cash, and they're investors, and you're submitting a 60-day
you're gonna get blown
contingency
out of the water.
sale, I mean, forget it. It's like a bazooka.
Well, and on top of it, if you haven't even put your house on the market yet,
right.
That's another huge thing. People, with contingent sales, well, I'm not going to put my house up on the market until I find the other house. No, you're not going to get the other house because they're going to go, well, have you even listed your other property? And if you haven't, you're not there. You might as well just, you might as well just say, nope.
Yeah, exactly. So it's not impossible. It's not impossible to do a contingency sale. It's just, it's not as easy as it was.
You have to put it in a box.
That's right.
You have to be, as long as you're in that box, you have a chance. But it just makes it more difficult.
Exactly. So what this particular episode's all about is giving you options. So one option I'm seeing that's become pretty popular is a leaseback. So a leaseback, what you do is you put your home on the market, you sell your home. You put in the clause that you are able to rent your home that you just sold up to 60 days.
Right.
Right? There's some lenders that only allow 30 days. Our company actually allows 60 days. But here's an opportunity for you to then go and buy the new home during that particular period. Now you have to have a stomach for it, right? Because you can't stay in there forever.
Yeah.
You have 60 days and then you got to go.
Yeah.
Right? But
by the way, there are all sorts of long-term places that you can go to. If let's say at the end of that 60 days you still are not ready to make that move, you can find other places like that are long-term hotels and things like that you can potentially move into. But generally speaking, you want to be able to be closed and then move on to the 60 days. Basically.
That's right. And really what you're doing is, just from an analogy standpoint, think about, okay, you're surfing and, you're paddling out into the waves, and these waves are massive, right? So it's not easy making that paddle out. But once you turn around and you're going with the flow of the ocean, then now you're flying, right? Now you're actually going with the flow of the transaction. So it's the same thing. So what you do is, you go ahead, you list your home. Now you have the power because now you're a seller.
Yeah.
Right? You're the seller. So now you have the power of the transaction, and you get to see this flood of offers coming to your home. And these people are so desperate in trying to get into any home. Sure, they'll do a lease back. No problem.
Right.
Yeah. You want to rent your own home for 30 days and give me an extra 30 days to move? I don't have a problem with that.
Right.
Right. Or 60 days. So now you are actually on the same side and harnessing the power of the market.
Yeah.
Right. So smart tip.
Yeah. And sometimes they'll even, if they're desperate enough, they'll, to buy your home, they'll give you a free lease back sometimes. You can work it out and say, listen, I want to stay in my house for an extra 60 days. Some people, if they really want your house, guess what? They'll pay you to stay there.
Exactly. Yeah. Yeah.
So,
and sure, there will be some people that are like, nope, I won't do it. But you have 8 other offers to choose from.
Correct.
Right? So 2 may say no, but 8 may say yes.
Right. All right. Well, let's look at tip number 8, which is carry 2 mortgages. So what are we thinking about there? I think
So
I own 2 houses.
that's right. That's right. So, paying your principal, interest, taxes, and insurance, if it wasn't enough to bear for one home, now you get to do it for 2.
2.
Right? But you might have to.
Yeah.
Right. So one of the biggest challenges for people is they can qualify to buy, own one home.
Yeah.
Right. But if you don't have a contingency offer and you don't do the lease back and you just say, no, I'm just going to buy the new home and I'll move in and, I'll list this thing. That's good enough for the lender, right? Wrong.
Yeah. No.
Wrong. We have to actually hit you with, for the debt to income ratio with both properties.
Right.
Right. So if you have the means and you have the ability and you qualify, you might need to employ this particular tactic. And what you'll do is you go ahead and we already calculate, okay, here's the principal, interest, taxes, and insurance. So the PITI for your existing home. And then we factor in the new home. And provided that you qualify for both of those, then yeah, you can do a 30-day, no problem. So you just go ahead and buy the new home. And you have 60 days to move in, right? So you have to take occupancy within 60 days of the new property. But now you're able to then take your time in selling your residence. So again, options. You don't have to do a contingency sale if you have the means to qualify for both mortgages. Now, I don't recommend it to do it for a long time.
No.
Right? Because that's a lot of money.
That's a lot of holding
right?
costs.
So if you're paying like $5,000 on one and then you have to pay $7,000 on the other, I mean, that's $12,000. That's a lot of money.
Yeah.
Right? And not everybody, qualifies from that standpoint. So if you have the means, then it could be an option just to get in.
Right.
Right? And that's what a lot of these things are about, is just to get in.
So then we kind of, speaking of taking your time, we've got tip number 9, which is sell the house first.
Yeah.
And have accommodations to stick around in while you're shopping.
Yeah. So,
By the way, that's a very smart, look, if you want to have a low stress way of doing this and you're okay with staying in some extended stay place or something, or with relatives, this is a totally valid way of taking your time.
Yeah, and I would say this was probably pretty common back in the day.
Yeah.
Right? So when families were closer.
I've totally had clients do this where it's, I had some clients who were from, I want to say Oklahoma, but I could be wrong. But basically they lived out here with their parents while they were doing the shopping.
Right.
And it made things so much more better because there was no pressure of, oh my God, we got to move on this day to get this thing to go, that domino effect.
Right.
Basically.
Right. And sometimes, a spouse will stay back, right, and sell the home and the kids in school while, the other spouse takes the new job in LA and they're selling the home in Missouri, and, that happens, right? So it and another piece of this is, again, you want to ride the wave, right? So if you feel that, man, I'm going to get top dollar for this, and it was $100,000 more than I was thinking. Yes, an extended stay could be maybe $5,000, but I mean, you have $95,000.
Yeah, right.
Right. So, and you're going to be able to use this extra proceeds to the purchase of the new home, and you can compete with the others.
Right.
Because now you're in a better position because you don't have a contingency sale. There's no lease back, and you don't have to stress yourself about carrying the 2 mortgages. You've just decided we're gonna make different choices.
Yeah.
And accommodations. So that one's pretty straightforward, and a lot of people, they do that, but it's good to remind people.
Right. And then we get into tip number 10, which is and by the way, I think this is literally one of the single most important ones, which is getting your lender involved with the process.
And with all of these, it's not just the lender, it's getting your team involved in the process.
Definitely.
Right? So the biggest thing to this whole piece is you have to dispel belief, right? And the belief is that you go to the open house and you love it, and you have a chit chat with the agent and you get to know them, and they go back to the seller and they say, oh my gosh, met this great, wonderful couple. They're so sweet. and it's this nice little love affair, and you take your time and you go through the process, and it's all of the all the stuff that you see in the movies and everything else. Now it is insanity. It is now where you have to be so buttoned up and professional. You have to think like you are applying for a $10 million business loan, or that you have the next great technology company and you're meeting with all the VCs in Silicon Valley.
You can't improvise this.
You cannot.
You can't make it up off the top of your head.
You cannot. And you can't, kind of pussyfoot your, around where you're like, oh, I think I'm going to make an offer. Or, yeah, let's go ahead and we'll do the,
let's rough
go
some
ahead
numbers
and,
together.
Yeah, let's do the pre-approval and then we'll put something in. Forget it. I mean, if you go to the open house and you haven't even done the pre-approval, you're done.
Yeah.
Forget it. You forget it. So you need to make sure that you are buttoned up and that you have your entire team on call, right? Yeah. So you have your lender on call, you have your realtor on call, you have your CPA on call, you have your financial advisor on call, you have anybody that is involved in gathering documents or input or whatever on call.
Yeah.
Right? Because it's so competitive, right? So that's kind of the general gist. Now, as far as getting your lender involved, I meet a lot of realtors too, right? So I've actually done this, and I always say, talk to your realtor first, right? And I always give that option is, okay, so what I can do is, let's say there's someone that is just, off the walls, qualified, they've got an 800 FICO. We've ran the automated underwriting system, and with Freddie Mac, their LP accept, they have a low debt to income ratio. I know this is going to go direct, and it's going to be a slam dunk. It's going to be an easy loan. They're W-2, and I just know that it's going to be completely solid. Well, that's information that I need to share with the listing agent.
Correct.
Because that is solid. It's cool that, you've got a golden retriever and you've got 2 little kids and they're adorable and in the welcome letter, but this is the real substance that a listing agent can take to their seller and get and really get your offer, in highlights.
When I start relationships with lenders, it's one of the first questions I always ask is basically, if I call you on a Sunday night and I say we're putting in an offer, are you going to get on the phone to that listing agent and basically tell the story of my clients and tell the listing agent and his clients, these guys are good. These guys are going to close. And having someone in your corner that does that is mandatory and is going to give you the edge over other agents who either are too new and don't know that that's important to do, or B, don't have a relationship with the lender, right? Because let's say that they have, we talked on a previous podcast about Morty, the mortgage
I don't see Morty doing this.
Yeah, Morty's not making a phone call.
No.
At 9:00 on a Sunday night to really say that Jill and Joe Smith are great clients and they're going to close. They have the figures and the money and the ability to make this close.
Yeah, and I mean, even in as big of a market as Los Angeles is, I'll go and look at the property that my clients are making an offer on. And if I know that particular realtor, I'm going to say, hey, I know that particular realtor. I know someone who knows that realtor. I've got a relationship. And I could just say, hey, Joan, I know that my borrowers, they're solid. You and I know each other. And we're going to be able to knock this out in 30 days. We're going to be able to meet the appraisal contingency and all these other, you're basically taking away the risk. And what you're doing is it's being proactive. It's like a proactive cross-qualification.
Yeah.
Because we're cutting it off. We're cutting out any doubt. We're eliminating all of that, the FUD factor, the fear, uncertainty, and doubt. So by being able to make that phone call, because the other lenders aren't doing it.
No.
Right? And they also... They won't do that because what they do is I'm talking about the big banks, right? So what they do is you come in and you go into the particular branch, you do the pre-qualification, they hand you that letter, and you never hear from them.
No.
Right? They're not engaged. They're not active in the process. And you just hand this letter all over the place, but you don't know what all of those properties entail, right? So, you might have been pre-approved for a single family residence, but you might not have been approved for a condo, right? So you need to get the lender involved in every single transaction that you're going to, every time that you're going to make an offer, because, A, we can customize it, right? So if you're pre-approved for $800,000, but the home's listed at $650,000, well, why in the world are you going to tell somebody you're pre-approved for $800,000?
Yeah.
Right? Customize it, say $650,000 or $675,000. So have a strategy for each of your particular offers, and make sure the numbers work, right?
Yeah.
So you want to make sure that that you have the ability to really do that. And if it makes sense, and you as the client, and also the realtor, if they want me to call, I'm happy to do it.
Yeah.
Right. So it really helps stand out because those other lenders aren't doing it.
And
all those other offers
going to get you an edge better than any picture of you with your 2.5 kids is going to do.
Yeah. I had a client, and I don't know if this was a client we had together, but I remember
which they're not saying you can't do anymore, by the way.
Well, right. Yeah.
Because of basically equal opportunity things and stuff like that.
Correct.
So, yeah.
Correct. But I had a case where it was funny. I had the, my client, the agent made the offer and asked me to follow up. So I called and vouched for this particular person. And he's like, you've got a pretty rough reception. Or you want to call me when you're a little bit further down the road. And I'm like, well, actually, I'm in the harbor in Jamaica.
Yeah.
So this is about as best of a reception as I could get. And he's like, you're calling me from Jamaica?
Wow.
Right?
Yeah.
And we certainly got our counter, right? Which is what you want. It's just a shot.
Yes. Look, there's in this market, it's probably a good chance you're going to just get countered, but at least you're in the game. Mm-hmm. You want to be in the game. You want to be in the scrum.
Right.
So that when, your top, if your top is, either above somebody else and you feel comfortable with that, even though you're paying your top, that's fine. And you can get the house. What does it matter at that point? You know what I mean? So it's these things that get you that edge, and you just, all you want to get is that other second shot. That's all you need. And these are some ways, I think that there are some very solid, very actionable things that you can do that can potentially get you an edge over other people.
Absolutely.
So, great. Well, that's about it for today. If you have any questions or comments, please don't hesitate to leave them for us on our Facebook page, facebook.com/Clarified Realty Podcast, all one word. If you have any questions about real estate, or you're looking for someone to help you buy or sell a home, I'm actually a licensed real estate agent. I'd love to help you out. So please email me directly at tom@clarifiedrealty.com, or give me a call at 818-335-7662. Don't be shy. Give me a ring. For more exclusive bonus content and advice between episodes, please check out our website, www.clarifiedrealty.com. Also on our homepage, you'll find links to helpful buyer and seller guides that can give you some great information for starting your home buying or home seller process. So definitely check those out. I'm on Snapchat, Twitter, and Instagram as well. My handle for all three of those are @ClarifiedRealty. Please leave feedback and reviews on iTunes or in the comments section on our page. Together we're stronger, so if you have any questions or ways that we can make this podcast even better than it is, please let us know. My amazing theme song, Hey Now, is from the band Wolf. That's Wolf with 2 Fs. And please go check them out and like them on SoundCloud. They rock so freaking hard, they won the bidding war for who can kick the most ass with their killer tunes. And just a little disclaimer, I'm licensed by the California Bureau of Real Estate. My license number is 01715353. Ron's is?
Guaranteed rate, NMLS 2611, NMLS ID 558706, California.
The advice we give is only for properties located in the state of California. For all other states, please contact your local real estate agent or real estate professional. Well, that's about it. Ron, you good?
Yes, sir.
Fantastic. Well, thanks for coming, everybody. And remember, the greatest thing you can ever do is make someone feel at home. Take care, and we'll see you next week.
What you gonna do with your